Let's start off, I guess, with the move in yields here, because after that jobs report, I think people kind of expected the market to go in a different direction than the direction it seems to be going on Friday and today here. What do you make of that sort of, at least the short-term moves here?
Well, I think Friday's number was clearly a disappointment and probably a very humbling event for those of us who are in the business of trying to predict the future. I think it's just another message to us that there's so much going on right now that it's very, very hard to predict. I do think from the Treasury markets perspective, this week we've got a lot to digest. We have lots of issuance, not just in the Treasury, but in the investment grade space. So a lot of supply coming on the bond market. So that's perhaps one reason why you see slightly higher yields. On the inflation front, though, Romaine, I think the market expectations are very well anchored. They really haven't moved significantly. We are sort of on that side as well, believing that inflation will not be persistently higher. So the market, Northern Trust, and the Fed are sort of all on sides right now.
Interesting with those higher yields. How much of that is, well, that cyclical trade really dependent on those yields climbing, Katie?
Yeah, Taylor, that's a great point. I mean, it's very hard to make a confident bet on cyclicals and on that sort of reopening trade without higher yields and a steeper curve. And we are seeing that today. I mean, we think the 10-year could probably trade between 125 and 175 over the next 12 months. We're getting towards the midpoint of that range, but there could be a ways to go up in yields right here. And that will create that steeper yield curve. So we still think there is some attractive opportunities in the cyclical and in the reopening trade.
How much more opportunity, Katie? At what point do some of those prices even look overvalued to you?
You know, Shanelle, it's all relative. And when we look at the relative valuation of growth versus value here, the chasm is as wide as it's ever been. Growth stocks are very expensive. Value stocks still look pretty cheap, particularly in this low rate environment with sort of these visible sources of growth going forward. We anticipate, as a matter of fact, that value stock earnings are going to outgrow growth stock earnings next year. So there's lots of possible really interesting tailwinds from a valuation and a fundamental perspective as we go into 2022.
It's interesting, Katie. I'm curious about coming off of this most recent earnings season, and in just a few weeks' time, we're going to be in a new earnings season. Expectations have been pretty high, and for the most part, expectations have been relatively fulfilled. And I'm wondering about the persistence of some of the margin expansion and the revenue growth that we've seen here, whether that can really sort of sustain itself into next year, 2022, where the market already seems to be priced.
Well, we certainly don't think we're going to have, 90% year-over-year earnings gains when we reflect back on 2021 from a 2022 perspective. We do think earnings growth is going to somewhat normalize, but we still think it's going to stay above trend next year. And the momentum behind some of these earnings stories is just very, very strong, Romaine. We continue to see very strong revenue growth. And as a matter of fact, what we heard from a lot of companies is that their revenue growth was in some ways constrained by lack of available supply. So we think as we see the supply constraints ease up as we get into 2022, we're going to have that demand growth still remain pretty robust. It spells a pretty good earnings season for next year. Now, I will say that while analysts typically are pretty skeptical coming into the quarter, this time has been a bit different, and we've seen analysts upgrade their expectations in July and in August for this quarter's earnings season. So they have raised the bar, which is a bit abnormal. Looking back at history, typically they get a little bit more pessimistic.
Katie, are the markets seeing a tailwind from potential future fiscal stimulus, or is it being offset by a headwind that could be either higher debt and deficits or higher taxes?
I think, again, it's all relative, and it will be in a large part offset by the relative strength of the fiscal impulse that we had in 2020 and 2021. So although we don't anticipate we're going to get a significantly large infrastructure package, we think the $3.5 trillion package is probably going to be very, very slimmed down and then stretched out over many years. So the immediate impact to the economy is not going to be very strong. And it's especially relative to this year where we had such a strong fiscal impulse. So from a relative basis, it's not going to be meaningful. And I don't think it's priced, any adjustment is priced into the market, because I think investors pretty much get that.
Katie, a lot of opportunities for bad headlines through the rest of the year. Is there any way that you're hedging against those?
Well, you know what? We always remind our clients that markets are volatile. You all have covered so well the fact that we've gone a long, long time before a normal 5%, let alone a 10% correction. And as you said, we have a lot of news coming into the end of the year. We have obviously a very busy calendar in September in Washington. So we always advise our clients to have high quality fixed income and cash on hand to really fulfill and fund their goals over these short-term periods that could be more volatile than expected, and you could see some pretty significant drawdowns in a market that's gone so far so fast.
Katie, we only have about a minute left, but I'd be remiss in not asking you here about the reopening, the whole return to office that is supposed to be happening now in this post-Labor Day period here. I mean, it's obvious from your shot that you're not quite back at the office itself. I'm curious as to whether you think it matters with regards to economic activity, whether it worries you at all about some of the delayed reopenings and whether that's factoring in at all into some of your strategizing here for some of your clients.
Well, I do think that it's having an impact on economic growth, and you can see when you sort of peel back the onion with some of the activity measures that urban office centers are not doing very well. So it's absolutely having an impact. And from our perspective, we just want to make sure that our partners are safe, our clients are safe, and that we're going about this in the safest way possible. And I think we're in very good company. So we anticipate we will get back to the office, but it'll be a slow process. And so again, it's sort of a recovery delayed but not derailed. And we anticipate a much better 2022 when it comes to that return to office.